Okay, so you want to own an airport. Your name above the terminal, planes lined up on your tarmac, airlines cutting you a check every time one of their jets touches down, the departures board clicking over every 30 seconds, every gate attendant, every food court, a captive audience that missed their lunch and has nowhere else to go. That's the picture, and honestly, it's not a wrong picture. Here's what it leaves out. An airport is not a transportation facility that also runs some retail on the side. The retail, the parking garages, the cargo leases, the bond structure sitting underneath all of it, that is the actual business. The runway is just what fills the building. In 2019, the city of Denver wrote a $200 million check just to fire the contractor on a terminal renovation that was supposed to cost $650 million and is now heading past $2.35 billion. That is one construction project at one airport, and the people who signed that deal believed they understood what they were getting into. Some airports are genuine financial machines, generating hundreds of millions a year from sources most passengers never notice. Some carry more bond debt than most American cities will ever issue in their lifetimes, service that debt on traffic flows they cannot fully control, and run a financial structure that nobody fully grasps until something goes seriously wrong. By the end of this, you'll understand exactly what separates those two kinds of airport and why the difference is never visible on the day you sign. Let's start with what you're actually buying, because airport covers a lot of ground. A general aviation airport is a small local facility, grass strips, private pilots, Cessnas tied down in a light rain, no scheduled airlines at all, maybe a fuel concession and a flight school generating a few $100,000 a year. A regional commercial airport handles scheduled service for a mid-size metro, a dozen gates, one or two carriers, passenger counts in the low millions. That is a manageable business with a narrow margin and real fragility the moment a single airline pulls its service. A major international hub is a different category entirely. We're talking about Denver, Dallas-Fort Worth, Los Angeles, Atlanta airports moving 60, 80, even 100 million passengers through their terminals every year. These are small cities. Dallas-Fort Worth covers more land than the island of Manhattan. Hartsfield-Jackson in Atlanta is the single busiest passenger airport on Earth. That is where this conversation lives, at the hub, not the grass strip. And the thing to understand about a hub is that it was designed from the beginning to do two things simultaneously: move airplanes efficiently and extract maximum commercial value from every single person it pushes through its doors. Those two goals are related, but they are not the same goal. Now here's the part that most people get completely backward. At a major hub operating under a residual rate agreement, and we will explain exactly what that means. Every dollar your concessions generate above a defined threshold goes directly back to the airlines as a credit against what they owe you. A packed terminal with record food court sales can, under the right contract structure, leave the airport's own financial position essentially unchanged from a slow year. The commercial upside you thought you were building was already spoken for before the first sandwich crossed the counter. So, what does it actually cost to get in? First, understand the ownership model, because you almost certainly cannot buy a major U.S. airport outright. American airports are almost entirely government-owned by cities, counties, port authorities, or regional airport commissions. The reason is not accidental. Airports were largely built with federal grants, tax-exempt bond proceeds, and passenger facility charges collected on every ticket sold. Federal law ties airports that accept those funds to public ownership and non-diversion rules that make private sale legally complicated and politically nearly impossible. What private operators can do is run the airport under a long-term concession agreement, a contract to manage operations, develop commercial revenue, and invest in facilities in exchange for a share of what the airport generates. That model is far more common in Europe, where Heathrow, Charles de Gaulle, and dozens of other airports have been partially or fully privatized. In the U.S., the closest equivalent is the public-private partnership, the P3, where a private consortium finances and builds infrastructure and recovers its investment through long-term operating rights. The entry cost for even a mid-sized terminal P3 clears $1 billion before the first gate opens. LaGuardia's Terminal B 35 gates, 2 island concourses, came in at $4 billion when it opened in 2022. JFK's new Terminal 1, currently under construction by a consortium that includes Carlyle Group and Ferrovial, is projected at $9.5 billion total. The financing structure for JFK's new terminal alone involves billions in special facilities, revenue bonds issued through the New York Transportation Development Corporation, tax-exempt debt secured not by the City of New York's credit, but solely by the projected revenue of the terminal being built. If the terminal underperforms, the bondholders bear that risk. The city does not. Here is the trap nobody shows you at signing. Every major airport carries a legacy capital structure built up over decades of prior bond issues, federal grant conditions, and airline use agreements negotiated by people who are no longer in the room. When you step into a concession agreement or a terminal management contract, you are stepping into an existing web of obligations rate covenants, revenue sharing provisions, and construction completion guarantees written by lawyers who anticipated problems you haven't thought of yet. Denver's original Great Hall P3 valued that concession at $1.8 billion over 34 years. What nobody had priced in was the concrete poured in 1993. Now, let's look at how an airport actually makes money, because the revenue stack is more layered than almost any other asset class in America. Layer 1 is aeronautical revenue landing fees and terminal rents. Landing fees are charged by the pound. At most major U.S. airports, carriers pay somewhere between $85 and $200 per 1,000 pounds of aircraft weight. A fully loaded Boeing 737 weighs roughly 175,000 pounds at landing. Do the math. That's somewhere between $15,000 and $35,000 every time one touches down. At a hub running 400 operations a day, landing fees alone move tens of millions of dollars per year. Terminal rents add another layer: gate leases, hold room space, ticket counter footage billed out at per square foot rates that reset with each new use agreement. At Denver in 2023, airline revenues, landing fees, and terminal rents combined totaled $459 million. Layer 2 is the commercial concession machine. Every restaurant, every retail shop, every newsstand, and every terminal operates under a concession agreement that charges either a minimum annual guarantee, a floor rent, the operator pays regardless of how sales actually go, or a percentage of gross sales, whichever is higher. Hudson News, which you have walked past in essentially every airport you have ever been in, is now part of Avolta, a Swiss travel retail giant that controls a significant share of North American airport retail. That Starbucks standing between you and your gate generated roughly $4 billion in revenue across airport locations in 2024. 12% of Starbucks' entire global revenue came from 47 airport shops, 47 physical locations, $4 billion in revenue. Think about what that number says about the captive economics of this audience. Layer 3 is parking. At U.S. hub airports, parking and ground transportation can account for over 40% of all non-aeronautical revenue. Dallas-Fort Worth generated $251 million from parking and ground transportation in fiscal year 2024 alone. Short-term garage rates at major hubs run $50 to $70 a day at the curb, and the lot is full because the alternative is missing your flight. Layer 4 is the one almost nobody prices in going in: pure cargo income. Cargo airlines, freight forwarders, and integrators lease warehouse space, ramp access, and dedicated cargo facilities at rates that held remarkably steady through COVID when passenger revenue collapsed entirely. At Hartsfield-Jackson, Atlanta, cargo operations support over 27,000 jobs in the surrounding metro region. Here is the false safety number that catches operators cold. Denver's non-airline revenue hit $562 million in 2023. That sounds like a healthy business. What it does not show is how much of that $562 million is already contractually obligated to cover debt service on bonds issued to build the very facilities generating that revenue. Now for the mechanism that actually determines whether an airport survives a real crisis or quietly bleeds out during one. The operating cost structure at a major hub is brutal in how fixed it is. Security infrastructure, runway maintenance, airfield lighting, the automated people movers shuttling passengers between concourses, the HVAC systems for buildings the size of small cities, none of these costs flex with passenger volume. When COVID dropped enplanements by 60% in 2020, the utilities kept running, the maintenance crews kept showing up, the bond payments kept coming due on exactly the same schedule as before. Denver's operating expenses in 2023 ran $578 million, and that is before depreciation, before debt service on billions in outstanding bonds, before capital reserve requirements. Total revenue that year was $1.02 billion. The margin looks reasonable in a good year. Look at it again when traffic is down 20% and those fixed costs don't move. But the truly fragile mechanism, the one that almost nobody outside the industry thinks about at all, is the use and lease agreement. This is the contract between an airport and its signatory airlines. Under a residual rate structure, which roughly half of major U.S. hub airports use in some form, the airlines collectively backstop the airport's costs. If the airport spends more than it brings in, the airlines make up the shortfall through automatic rate adjustments. On paper, this sounds like protection for the airport. In practice, it means the airlines have contractual leverage over every major capital decision the airport wants to make. Under a compensatory structure, the airport sets its own rates and bears its own financial risk, but keeps all the commercial revenue upside. Here is the mechanism that actually changes everything. At a residual airport, strong concession revenue directly reduces the net cost requirement that airlines have to cover, which means a record-breaking food court year lowers what airlines pay in landing fees, and the airport itself does not keep the margin. The commercial revenue that looks like profit is actually a subsidy flowing from your food courts directly to United Airlines. That is the structural trap sitting inside the most common airport operating agreement in the United States, and it is the exact agreement that shapes every capital decision an airport makes, including whether to sign a $1.8 billion P3 to renovate your terminal. Denver International Airport opened in February 1995, 18 months late and roughly $2 billion over its original construction budget, already a pattern worth noting. By the mid-2010s, the terminal's Yepesen Hall, with its famous white tinsel roof designed to evoke Colorado's mountain peaks, was showing serious strain. The airport was handling close to 70 million passengers annually through a building originally designed for 50 million. In 2017, Denver signed a 34-year concession agreement with Great Hall Partners, a consortium led by Spanish infrastructure firm Ferrovial, alongside Colorado-based Saunders Construction and JLC Infrastructure. Ferrovial put in $258 million in equity up front. The construction budget was $650 million. The full concession value over 34 years, $1.8 billion. At the time, this deal was described in the industry as a model for the future of airport financing in America. Within 1 year of breaking ground, it was in collapse. The problems began when structural engineers discovered that the concrete in the original 1990s construction didn't meet the strength specifications needed for the renovation work above it. Scope changed, then design changed. The airport began issuing change orders at a pace that Great Hall Partners said was unsustainable, and Great Hall Partners began documenting what those changes were actually costing. By the spring of 2019, the contractor's internal projections showed overruns of $288 million, 44% above the original construction number, with delays pushing completion past February 2024. The airport accused the contractor of intentional misconduct. The contractor accused the airport of issuing so many change orders that the original contract had effectively been rewritten out from under them. In August 2019, Denver's mayor fired Great Hall Partners and terminated the 34-year agreement. The city then had to write a check a minimum of $200 million just to reimburse the consortium for the financing it had committed at the start. Airport CEO Kim Day left the following year, with the Great Hall collapse cited as a contributing factor in her departure. Denver then spent the next several years rebuilding under conventional contracts what was supposed to be a landmark private partnership. The final projected bill, $2.35 billion at minimum. Completion date, 2028, 7 years behind the original schedule. The lesson is not that public-private partnerships don't work. LaGuardia's Terminal B, also a P3, came in on time and under its budget. The lesson is that a 34-year concession agreement is a document written to anticipate every foreseeable risk, and concrete poured wrong in 1993 was not on any forecast. So, if the airport itself is a government entity that cannot be privately owned, and the concession model involves 9-figure commitments to get into the deal, and the use and lease agreement can route your commercial upside back to the airlines who actually profits from all of this? The answer, in the United States, is the bond market. Here is how the structure actually works. Airport revenue bonds are a subset of the municipal bond market. They are issued by a government entity, the city, the Port Authority, the Airport Commission, and secured by a pledge of future airport revenues, landing fees, terminal rents, concession income, parking, cargo leases, and passenger facility charges. PFCs are a $4.50 fee collected on every enplaning passenger at major airports, authorized by Congress in 1990, and pledged directly to bond repayment. At the 30 largest hub airports in the U.S., PFC collections total roughly $2.4 billion a year. That is an enormous, legally reliable securitization base, and because these are municipal bonds, the interest income is exempt from federal income tax, which means pension funds, insurance companies, and institutional investors accept a lower stated interest rate in exchange for the tax benefit on what they earn. The airport gets cheaper capital than a private borrower ever could. The investor gets tax-sheltered yield backed by an asset that virtually every city and county in America is legally committed to keeping open. The private operators who make money directly in this system are the concessionaires companies like HMS Host, Avolta, and OTG Management, who negotiate minimum annual guarantees, invest in build-outs at their own cost, and extract returns from high-traffic captive audiences over 5 to 10-year contract terms. And the infrastructure private equity players, Ferrovial, Vinci Airports, Carlyle, Macquarie, who take long-term operating positions in individual terminals and recover their equity through operational efficiency and commercial development stretched over decades. None of them own the airport. None of them need to. So, what does the realistic financial picture actually look like for an entity operating inside this structure? In a strong year traffic up, no major capital emergencies, concessions running above their minimum guarantees, Denver in 2024 brought in $1.18 billion in total operating revenue against $652 million in operating expenses before depreciation and debt service. That is a real gross surplus on a government-owned facility. In a hard year in 2020 is the data point nobody operating an airport wants to revisit passenger volume drops 60% in weeks, not over months. Every concession minimum guarantee gets deferred or waived. Every airline lands fewer planes and pays lower total fees as a result, but the bond payments do not get deferred. Denver alone had to navigate roughly $92 million in airline payment deferrals through 2021 payments it was legally owed that it was not collecting while the debt service clock kept running on the same schedule. The honest uncertainty that this picture cannot fully resolve is what happens when a major hub airline restructures or walks away. When a signatory carrier reduces its presence, it takes its gate utilization, its connecting passenger traffic, and the commercial throughput those passengers generate out of the building with it. United Airlines is Denver's single largest carrier. In 2014, United restructured its Denver lease in exchange for a $25 million annual reduction in debt service costs. The airport secured a lease extension locking United through 2035. What that negotiation revealed was that the airport needed United at least as much as United needed Denver. That is the structural reality of hub dependence, and it is the one number no departures board ever displays. Here is what you actually understand now, that most people working outside this industry never reach. An airport is not a place where airplanes land. It is one of the most sophisticated captive audience commercial platforms in the American economy, a system engineered to extract maximum revenue from every person who passes through the door, financed by one of the most creative infrastructure capital structures ever built inside American public finance. and operated under agreements that can quietly reroute the commercial upside you thought you were building back to the airlines who fill the building in the first place. The runway is the marketing. The terminal is the business. Denver signed a deal in 2017 thinking it was buying operational efficiency and 34 years of predictable returns. What it was actually buying was a 34-year relationship with concrete someone else poured in 1993. Own the building or own the concession. Either way, read what's underneath it first.